Hello everyone and welcome to my YouTube channel. My name is Khosrow Sokhanvar, presenting to you the third episode of price action course in market cycle methodology. In this episode, we're gonna talk about different order types because I think it's important to know because it gives us a clear view about supply and demand methodology which we use in the future to explain better that market cycle methodology. Because what we will be talking about in this course will be all based on supply and demand, which is the nature of market, not some imaginary patterns that in many other methodologies they teach, but we talk about pure supply and demand methodology. Okay, it's Binance website, which is a centralized exchange for cryptocurrencies. I chose this symbol because it has a low volume, so it's not changing very quickly and we can see better the orders. So for different orders, we should know the concept of maker and taker orders. What is maker? Maker is, imagine you're gonna sell something. For example, you're gonna sell a car and you go in the market and you announce that I sell this car for example, 10,000 euros, and you wait for a buyer to come and buy it from you. In this case, you are a maker. You are making limit order. Or you go to the market, you are a buyer, you say, I have 10,000 euros and I want to buy this particular car. And you wait for someone to come and sell it to you. In this case, you are a maker. You are making a buy order. And if you are the person who sells that car, you go to market, you see someone wants to buy a car for 10,000 euro and you sell it to them, you are a taker in this scenario. It means that you took that order, and it's the concept of market orders. Or if someone is selling a car for that 10,000 euro, you go to market and you buy it from them, it means again you are a taker. You are taking that sell order. Here we can see the maker's orders. Here there are sell orders here, which we see the lowest price and it goes up. Because as a taker, if you want to take something here, you prefer to take it from lowest price. And here there are buy orders. Again, they are makers, which they put their orders. And as a seller, if you're gonna take an order, you prefer to take it from highest price. So what are these limit orders? It means that you are making an order. You are a maker here. You put a price, here is limit, buy order, sell order. For example, you say, okay, the price is 1.914. You say, okay, if the price goes down to 1.900, I would like to buy, for example, 10,000 of this cryptocurrency. And you need this amount of dollar and you put your buy order. It places it here, 1.900 here, and you wait for people to sell, or takers, sellers to sell to all these people too. Then they arrive to your order, then they take your buy order. So you will be a maker here, maker of buy order. Or you can say that, okay, the price is 1.917. I want to sell for the price of 1.92, for example, this amount of this cryptocurrency. And 1.92, if you place the order, it places your order here. So there are people ahead of you because they want to sell in lower prices, and if a taker buyer comes and take all these orders and reach to your order, it will take your order. So you will be a maker here, and it's a limit. Concept of limit orders. Other type of order is market order. It means that you are a taker. If you want to buy something as a taker, you go to market order, you say, okay, I want to buy $10,000 worth of this currency, and you buy. It starts to buy from these makers for you. We want to buy 10,000 USD here. And you see that here, when we go up, we put the cursor here, we see some USDT, and we go here, it starts to buy all these orders here for you. So the price you are buying is not 1.916. It's the average price between all these prices. And again, as a seller, if you are a taker, you say, okay, I want to sell, for example, 20,000 this cryptocurrency, And if you place your sell market order, it starts to sell to all of these buyer makers. And we see that it is some, and we go down. Let's reduce the amount to, for example, 1,000. Yes, it starts to sell to all of these makers for you. So the average price of which you have sold your asset is lower than this price because it's the average of these prices, all these prices. So it was the concept of different orders. There are other orders or other types, which is stop limit, trailing stop, OCO. We just wanted to talk about these two types of order because we work mostly with them. But if you wanted to have more information about other types of orders, you can just simply search in Google and read about. Okay, so it's the concept we needed for the future. And in this episode, we gonna touch briefly about our methodology, which is market cycle methodology. Very briefly, just as an introduction. What is our market cycle methodology base? It says the market consists of three different phases, which are forming one after another. The first phase is spike, or better to call it breakout spike, which is a very, very strong uptrend, all green candles one after another, and in a bearish scenario, all red candles one after another. And then the market goes through different corrections like this, and we call it channel. Then the market forms a channel, and after forming this channel, it goes to a trading range like this between two zones. And these three cycles are present always in all the times in market, and we're gonna see some examples. Don't worry about this concept. It's very, very, very simple concept, and we will talk about each phase in different episodes, maybe for each phase in 2 or 3 episodes, and we expand our information about all of this and how to trade them in market. In this episode, because it's an introduction, we just gonna see some very simple examples to see that this is being formed all over the market. We see a trend line here and we expand it. Here we see a breakout or spike. Breakout of this trend line. Here we see that very, very strong candles one after another. And then it goes to different corrections and it forms a channel. A channel and then a trading range between two zones. Then we see a spike or breakout of this zone, spike, and then it goes to channel and then a trading range. We will see in the episode about trading range that it's not necessary to form this kind of pattern, goes down and up, but this is a trading range and it can goes up like this. Okay, we're just seeing some examples. Let's go to 5 minutes time frame, remove my drawings to see some more examples. Okay, here we have a very important resistance zone, breakout here, and it goes to a channel and then a trading range. Again, breakout and channel and then trading range. Here have this trend line, breakout, then channel, here different corrections and trading range. Again, breakout, spike, corrections, channel and trading range. Breakout, channel and trading range. We have breakout of this zone here, channel and trading range, or better to say it was trading range. So spike, channel, trading range. Here breakout of this trend line, which has expanded, breakout, and here is very small micro channel, which if you go to lower time frame, like 1 minute time frame, you will see it better, and trading range. Again, spike, breakout, channel and trading range. A spike, breakout, channel and trading range. Again, here we had a very important trend line, a spike, channel, and trading range. Yeah, we see this trading line. Then again, there is a trend line here, breakout, a spike, channel, and trading range. I just wanted to show you that all over the market, these three phases are being formed one after another. So we can analyze all the market if we can recognize in which phase of market we are now. But in the future episodes, we talk in detail about every phase, how to trade it, how to recognize it, and how to draw these trend lines, how to know that where is that channel, how to know where the trading range is being formed, how to trade them, and we go in depth in all of them. I just wanted to have an idea what is market cycle methodology, which is completely based on supply and demand theory, and you just need to go to the charts and try to just find by eyes different phases. You don't need to be accurate, you don't need to be correct, you just need to go and see that these three phases are being formed always in the market. And in the future episodes, we start with spikes or breakouts and go to different phases to see how to recognize them, how to trade them, and how to make money from them in the market. Okay, I hope you go and find these three phases. Till the next episode, my name is Khosrow Sokhanvar, trader and investor in financial markets.